Okay.
Good afternoon, good evening. Małgorzata Bonikowska, the Center for International Relations, Poland, European Union. Welcome on this discussion on international financial markets and global economy. We are doing this seminar, this roundtable, as a first of the series we want to launch next year about relations between different continents, especially Europe and Asia. We call it the online bridge. So I hope this bridge will make us closer and will let us understand better the situation we are now. Very difficult year. Let's hope it is over soon and the next one will be maybe more stable. But the financial situation and the global economical situation is something everybody discusses now, both in Europe and in Asia. And to discuss it, we invited 4 people who all 4 are both the experts in the field, but also they do it in practice. Let me introduce the guests first. Mrs. Magda Wierzycka. Magda, dzień dobry.
Dzień dobry.
Hello, Magda is speaking to us from London, actually, right?
Yes, indeed.
Magda is a Chief Executive Officer of Sygnia Group, originally from Poland, but she works and lives in South Africa, having operations also in the UK, in Europe, in the US. So her Sygnia Ltd, it's an investment fund. You can tell us more about the company later on, but your perception is very global, so we can't count very much on your view on that. Mr. John Levack. Hello, John. Oh, John, let me introduce him in a second because I think he has a problem with connection. So Slawomir Lachowski. Sławek, hello.
Hi.
Sławek is speaking to us from Gibraltar right now, so Europe still.
Yeah.
And Sławek is a founder, and we call it even a father, of the mobile banking in Central Eastern Europe. He was a founder of Mbank, the first e-bank in our region. And he's now also in the sector, very much launching and operating other businesses in financial sector. And Irek Ozga. Irek, hello.
Hello.
And Irek is talking to us from Gdansk.
Warsaw.
From Warsaw this time, from Poland. Irek is a founder and a CEO of a company called Vici Group, which is one of the largest exporter of different goods, especially food, to Asia, different Asian countries, China included. And John Levack is logging on. I hope he's with us very soon. John Levack is a vice chairman of Hong Kong Venture Capital and Private Equity Association. So he will speak to us from Hong Kong. We got his contact through the partnership with the Hong Kong Economic Trade Office in Berlin. So thanks for this contact. I hope we'll be able to hear John soon. But first question I would like to put to Magda, actually, as being very international in your business. I want to quote certain statistics and I want to hear your feedback on that. Of course, the other panelists as well. We have a survey done in March. So March, it was just before the pandemic started really in Europe, and this was during the pandemic in Asia. And this was a survey done among 150 largest investors, private equity, venture capital funds in Europe, Asia, North America, and South America. And I just quote 3 things. First, that 74% of the respondents were saying that the operations into 2020 will be worse. It means that they expected 10% decline in their operations. However, in the same time, and again, I quote, 3/4 of these companies said that they look for new opportunities during pandemic. They see it as an opportunity time, and in conclusion, the third thing I want to quote is that they believed in March that their companies, private equity, venture capital, will be beneficiaries of this time because A, they will have more opportunities, B, they are very well prepared for such time because they are able to manage risk and they are very flexible. They can use this moment. So, John, are you with us already? John? Still problem. Okay, Magda. So first question, what would be your judgment after 11 months? Because this was done in March. Now we are in December.
So look, I think that, these statements are not incorrect for the financial services industry. So, the main global response to the pandemic crisis has been, escalation of the same policies as were employed.
So I'm sorry, I had some.
Yeah, continue. I think
John has the global financial crisis, which is basically resulting to negative interest rates and printing of money. So
technical problems here, but I hope.
Sorry for that. Just continue. Mm-hmm.
Now, so the world is, kind of awash in liquidity in terms of there is plenty of capital available. At almost negative interest rates or, zero interest rates. And so that capital is available for deployment, particularly for financial services companies. Now, if you look in the private equity space, or if you look in the venture capital space, venture capital is slightly different, but private equity space, you are certainly looking for opportunities to buy businesses and you're looking for turnaround situations. So in a situation where you've got access to, huge amounts of money at basically zero financing cost, and then potentially you have companies which are stressed or maybe not in distress because you wouldn't, that's a different part of the financial services industry, but looking at distressed opportunities, but certainly stressed opportunities. So companies which in a normalized economy would be doing well, but given the pandemic, the valuations have come down and, they're feeling the pressure, be it because, of lockdowns or because of consumer spending or whatever it is, then certainly the opportunities for private equity type businesses and financial services businesses should be there. Having said that, I think that there are a few other factors at play, and that is that there is so much capital in the markets that rather than there being a lot of opportunities, there is a lot of overvalued situations because there is almost too much capital chasing too few opportunities. So the quality of the transactions that are being concluded are not necessarily, first of all, at high valuations than one would want to, and there are fewer true opportunities available relative to the number of funds chasing those opportunities.
May I ask you, Magda, what was your reaction as Sygnia Ltd? And if you can just tell us a little bit more about your operations and also your decisions as a person who is a CEO of such a company.
Look, again, we run different types of products. So, you've got different responses within different divisions. Sygnia is a financial services company, and we offer a whole lot of administration, savings products, and asset management services in different guises, from passive to active to alternative investments. So we certainly have seen quite a lot of stress in the business, which we expected from savers who save through traditional retirement savings vehicles, because there were a lot of retrenchments coming through, and hence people either stopped contributing to their retirement funds or had to withdraw their savings. So that part of the business, we saw outflows. On the other hand, those outflows typically have to go somewhere, so they then move into individual savings products out of corporate savings schemes. So there was a big uptick on that side. We are a low-cost provider, so again, people started looking at fees and management fees charged on their savings. So being a low-cost provider, we benefited from that side. So for us, we had a record year. Our financial year end was September. And, I think our earnings were up over 80%. So, we did have a record year as a financial services group, but that is in the context of being a low-cost provider, being able to, market into the right target markets, also having some alternative products on the table.
Okay, thanks for this introduction. Let me maybe move now to Slawek. Slawek, because you have also in the same time, you were continuing your not only investment, but first of all, your thoughts about new businesses, and you were also working on this new bank project. How would you see the situation? How would you comment on this survey? It was done in March. Slawek, please unmute yourself.
So, as a matter of fact, the private equity and venture capital source didn't get worse. So, what we see is, especially in the second and the third quarter of 2020, a lot of new funding rounds are closed in fintech as well. There are, let's say, money flow coming to fintech operations, Europe and US. So, the pandemic, what the pandemic makes visible is the speed up of the development in fintech. And because of the increase in speed up of the adoption of digital among individual customers, so the fintech and financial services going towards digitalization simply profits from what's happening, and as Magda mentioned, there is money on the market, and the projects which are in progress all over the places, and this is important to mention. US, Europe, Asia are ready to ask for money and come up with projects which can be really funded.
And so, do you see the difference of opinions in Asia and in Europe, because you operate in both these continents?
Asia, you have to divide Asia into like China and the rest, and Southeast Asia. China, as far as digitization is concerned, is actually most, I would say, most advanced in the world. You'll be struck by the fact that adoption especially in mobile, in financial services in China is the highest in the world as compared to US and even to Western Europe. So Asia has a lot of unicorns already in financial services in every segment. In retail banking, in peer-to-peer lending, in wealth management. There are differences, and you will wonder when I'm saying that Asia is ready for the disruption and adoption of digital financial services at a large scale. And this happened also, not only because the advances in financial services as such, but because of the advances in technology. Simply, if you take, the mobile handsets, especially smartphones, which are, as a matter of fact, supercomputers, and more and more, accessible for masses. So then you will see that it is not like it was the case before. You need a computer, laptop or desktop to be digital. But nowadays, what you need is a smartphone. Mm-hmm. And fine, not everybody, but maybe a small fraction can afford Apple, but there are, smartphones available for 100 US equivalent of $100 in the places like Myanmar, mm-hmm. and India. So you may expect Asia embracing digital in all possible sectors. And last but not least, I will finish it for now. Financial services is the sector the customers can profit most.
Okay, thanks. Let's hope if we can hear the voice from Asia. John, are you able to speak with us now? John, can you unmute yourself?
Yes.
Oh, what a pity we have such a poor connection. John, maybe you can switch on the switch off the webcam and just try to speak. If
I'm having some connection.
Maybe that will help. But in answer to your question where a few months ago, the survey was predicting a 10% reduction for private equity portfolio companies. In Asia, we are more buoyant than that in our outlook. And part of it is that from a GDP point of view, and this is aside from all of the deaths and the suffering that has happened in COVID, but on a GDP perspective, Asia has had a relatively good COVID-19 experience. And if you take the G20 economies, I believe that China is the only G20 country that is expected to see growth this year over 2019 in its GDP. And a number of other Asian economies are growing, and where they are shrinking, the shrinkage is probably less than is happening in Europe and America. So the general background is not too bad for Asia. And if you take Asian private equity, the private equity businesses have tended to transition away from making investments in manufacturing companies. And the focus today is much more on the sorts of sectors such as e-commerce, education, healthcare, and fintech services, which have actually benefited from the crisis. And it means that amongst my peer group in Asia, quite a lot of them are seeing gains in their portfolio as they get towards the end of 2020, rather than the sort of declines that were forecast in your quotation.
John, I want to ask you about one more thing, because it has been over 20 years that you operate from Hong Kong, which is considered to be a financial hub, building bridges between the West and Asia. And this year we checked the rankings again. Hong Kong was nominated #1 in the Fraser Institute ranking of the freest world economies. Fraser Institute is a Canadian education organization, a prestigious one. And Hong Kong also still, despite the pandemic and despite also the global situation and local situation, is winning in the category of freedom of trade as far as international and the regulations. So what would be your prediction, and what is your observation about this place as a financial hub between Europe and Asia?
So I think Hong Kong has changed a little bit in the last year and will probably drop down some of the freedom rankings in the future. But as a place to do business, and if you take the private equity community, most businesses in Asia, most businesses in Hong Kong have a large China element to what they're doing. And typically across Asia as a whole, 50% of all private equity business in the last few years has been investments into China. So China is a really important market, and Hong Kong is a really important place for doing business in China. And the changes that have been happening to Hong Kong through legal changes and the national security law that have been imposed here does not really impact businesses' capability of doing business in China, because the national security law already applied to them in China. So for many private equity businesses, the stance is that nothing much has changed. Hong Kong remains an extremely good base for doing business in China.
Okay, thanks. Yes, Slawek.
If I may, first, we have a question from the public. Some experts claim that the pandemic is paradoxically going to strengthen China's position as global economic powerhouse. And this is, somehow in line with what John was saying. And what I would add to it is only that, it looks like China is marching a different drummer. It is the only country among the major world economies that it is expected to grow in 2020, when at a significant level of 2%. And, as far as the prospects for 2021 is concerned, China, is expected to grow at the level of 7.5. So this is something which will strengthen China as an economic powerhouse. So I visited, China before pandemic frequently. So at least once a month through Hong Kong and so on. So and I've seen it's not only about the numbers like GDP. What you see and what you experience is that the masses in China embrace digital, and the Chinese companies are not the followers and not the production side. They are more and more to be seen as innovators in different sectors, including financial services. When you see Tencent and Ant Financial being probably one of the powerhouses in financial services.
Thanks a lot for this data. We are all a little bit worried in Europe about the prospects for our economy. And of course, we compare to China. China is the only country on plus right now at the end of the year. That's why also in Europe, we have this financial help, enormous financial instrument, which is the EU budget and combined the EU anti-COVID fund. We'll talk about it a little bit later. But I would like to move to Irek, because Irek, you export to Asia all the time, and your operations have grown this year. What would be your perception of the economic situation and also the position Europe vis-a-vis Asia, especially China? Unmute yourself, please.
Thank you. So there is, of course, many different factors, but what we can observe on food business, which is our main part of operations, is that we have increased sales to China this year by 100%, just doubled the sales, which means the country is still the consumption, because we are selling consumer goods. So it seems that there is no negative impact on this consumption, and usually also the imported goods are a bit more expensive than local produced. So we don't see any negative impact, in fact. But I think that there is many reasons just beside the money in the pockets of the people. When you look at the very long-term project of China, like Belt and Road, you know, this project which are developing independent from only sea routes, the logistic chain between China and Europe by the train connection. Chinese were developing this for so many years, and it was kind of a small, just very small part of the total trade. And in fact, this year we can see a huge impact of this long-term infrastructure preparation of China for any disturbances in the logistic chains. Can you imagine that this year the train connection between China and Europe increased traffic, increased volume of number of containers by 98%.
Wow.
98%, reaching this year more than 1 million containers.
These are goods both sides, or they're mostly goods?
No, this is the total traffic. And of course, in many countries, it means like in Poland, for each container of exported good, it means 14 containers imported from China. But I'm saying about the total turnover, which is just generally important for the also economic situation of China and the connection and opportunities between two continents. So during the year of this corona, there were many disturbances in the traditional logistic chain, which is the sea routes. You can imagine that at the end of April, the Shanghai containerized freight index was at the level of 818 points. At the moment, there is 2,312, which means that the cost of shipment of container between Europe and China now is, let's say, 2.5 times higher than in the beginning of the year. Yeah, and the train connection is still at the same level. So it became more and more competitive. And of course, you have to remember that during the beginning of the pandemic, especially, there was a lot of disturbances. Ships which were on quarantine for weeks and months. In port of Ningbo, ships were 1 month on quarantine, Hong Kong and others. So the delays and the problems with the logistics were very huge and impacting many businesses. You know,
but how did you do it then in your particular case, your operations that you were able to
in fact, it was very, you know, one of the very simple answers, diversification of the logistics, and we moved a lot to the train connection, which is, you know, the lane is available. Of course, even now there's the situation, there is an overflow of goods. There is so many companies which wanted to use this connection that it's, in fact, now there are even delays on this, which means the economic activity on this connection is absolutely at a very, very high level. Mm-hmm. And I think, you know, what is important, you know, in our budgeting for the next year, in fact, I would just follow what Slawek has told, that we are expecting the increase of share of China in our sales mix. So they will become even more important for us, which means for Polish food business, for food production, because we're mainly selling the food produced in Poland. So they will be more important than this year and the previous years. Which means, you know, if you do it versus other countries, so generally they were prepared also with logistics, long-term investment, and the companies in China, you know what, we were in the beginning of the year, we are just afraid, okay, how many of our clients in China will survive? Yes, in the beginning, you know, when you looked at January, February, March, it was some kind of very, very terrible, you know, situation. The information what you have seen on the media was really disastrous. And we were even saying, okay, how many of our customers will survive? So saying the truth, all of them survived, and we doubled sales versus previous year. And the plan for the next year is the same dynamics with much bigger scale. Mm-hmm. So this is short answer also to one of the questions from our viewers.
Magda, I want to ask you now, because you don't have, I think, direct operations in China. Maybe I'm mistaken. but you have an overview of, you know, global overview of different places it is worth to invest, and the people also go and invest money there. What would be your perception for the next year also, you know, as far as when you look at Europe, when you look at the United States, when you look at China and other countries of Asia, and of course your South African perspective?
So you know, clearly, I mean, the general expectation is that global economies, and that, you know, is applicable globally, are going to rebound next year, and very strongly so. And you know, that is obviously already kind of anticipated by, if one looks at the listed markets, by the listed markets and the valuations that we are seeing. Now, you know, the problem with China and investing in China is that, you know, it has never been an easy game. So unless you have operations in China and you're an established player, it's actually extremely difficult to gain access to that market as an investor, particularly, you know, if it comes to, in fact, whether it's listed or unlisted investments. You know, it's a very different opportunity set, and you do have to have specialist expertise and specialist skills to play in China. And look, it's undisputable that, you know, if there are any beneficiaries of this pandemic, it is China. And, you know, I attribute it strongly to the fact that, you know, they've got a very centralized government, which could respond very quickly to the pandemic in two ways. You know, the plan A was, you know, how do you actually respond to the situation at hand? The second one was, how do we benefit from the situation in play? I think they will also benefit from the fact that, you know, the Trump administration is out of power, and hence the sanctions that US was starting to apply, and pressure US was starting to apply on China, have lessened. But from, you know, kind of general investment perspective, I think given what has happened in terms of the virtualization of the world and the technology boom that has resulted as a consequence, one needs to look, and, you know, I'm talking to public markets and listed markets, one needs to continue looking at the beneficiaries of this pandemic. And the beneficiaries of this pandemic have certainly been sectors which are technology driven, as well as anything to do with life sciences and healthcare. So on, you know, the technology side, it's never mind the trading platforms, and anything to do with online sales. It's also associated services, you know, courier services, delivery services. It's anything to do with online entertainment, streaming, gambling, gaming. It's online trading. It is, and then obviously anything to do with pharmaceuticals and healthcare, because the spotlight is so bright on those sectors. You know, in terms of, you know, so that's kind of the sectoral play. In terms of geographical play, you know, I remain fairly cautious of Europe, as much as it's undervalued relative to the US, for instance, simply because we still have to see what the effects of Brexit will be. There are obviously a lot of different strains and stresses within Europe. So I think the opportunity set is smaller. And in terms of the kind of tilt orientation in how, you know, we think about, you know, managing assets at the moment, certainly Southeast Asia is one, simply because the pandemic has had a much lesser effect on those economies, and then the US, just because of the volume of money that's being printed, you know, in that country and thrown at the markets, and also the fact that, you know, most of the large technology plays are really listed in the US. So between your Amazons and your Googles and, you know, your Microsofts, I think the boom in those counters will continue. So our view is US and Southeast Asia. Europe, you know, is kind of second play, and certainly not Africa. I think Africa, unfortunately, is, you know, is going to suffer very severely from this pandemic.
if I may ask you in this place about, also in Europe, we have Central Europe, our region, Central Eastern Europe. Do you think we still, economically speaking, Poland is not in a bad shape? We still have minus, but not such a big minus like some other countries in the West. Any judgment on this particular region for the next?
Well, I think, Poland from a, first of all, it was the almost, the fastest growing European economy. So it was in a better position than others to withstand the pandemic. But having said that, Poland also wasn't hit by the pandemic in a particularly, strong way. So, in the first wave, it seemed to have weathered the storm very well. I think that the storm has only come through now, which is why I think, if you look at the GDP numbers in Poland, they are a little bit distorted by the fact that the economy was, entered the pandemic in a better space and then wasn't really hit that hard by the first wave. So one needs to start looking at what the effects of, this general lockdown that Poland has entered into now will be on next year's numbers. So I think, Poland is a little bit of a will have a bit of a delayed economic reaction to the situation. But, from a global investment perspective, I think Poland has always been about property. That has been the big sector that everyone has been interested in, and that's the sector that featured in global portfolios. So we will have to see, because again, given the virtualization of interactions, suddenly commercial property is much less of an attractive, at least office space, retail. Suddenly all of those kind of property investments start looking a little bit less attractive than they would have before.
Right. John, let me ask you now at this moment, because Magda said about certain specific know-how the European companies or Western companies should have while entering Asia, especially China and Hong Kong. That's just specializing in building bridges between these two. And also this fact that it was for such a long time under the British rule. What would you see now as far as the behavior of the Western companies, as far as how they look at Hong Kong, financial operations through Hong Kong, which Irek also is doing, and China as a market for the next year?
So as a financial hub, Hong Kong remains extremely competitive, and it is an open place where it's easy to set up and build a business in Hong Kong. I agree with Magda that for entry into China from a financial services perspective, there are difficulties. And for instance, from a private equity point of view, you need to have Mandarin speakers and mainland Chinese people on your team to be able to produce good quality deals in China. So that there are barriers to entry. In Hong Kong, a lot of the financial sector firms have increased the number of mainlanders who are on the payroll enormously over the last few years, because that is the way that you do business in China. For the rest of the region, it helps to have local people on your team, but on the whole, if you're based in Hong Kong or Singapore or in country in most of the Southeast Asian countries, you can operate quite successfully. And from an investment perspective, Magda was talking about certain sectors where there is good opportunity, and I would hold that if you're following a sectoral perspective across all of Southeast Asia, China, and also into India. And India has had quite a tough time in COVID because it's been harder for them to isolate that. But even in India, the opportunities as the industry restructures itself and takes on board more e-commerce type activities, there are great opportunities to be had in India. So it is perhaps more sectoral led opportunities across the region rather than GDP led opportunities that are probably most attractive right now.
Thanks a lot. Sławek, I want to ask you two things, actually. One is I want to do a follow-up what Magda was starting to say about the Brexit effect, because even, you know, in your case, actually, Gibraltar is a part of the UK, and there was a reason that also you decided to operate from this place. So what would be the effect of this process? And one more question concerning the fintech sector, because you were an innovator, you still are. You were a father of our mobile banking. Now there are so many things happening in the fintech sector. So what would be your understanding about how this sector will develop next year?
First, you know, as far as Brexit is concerned, you know, it all depends actually of whether there will be a deal or not, right?
We will know in a few days. Mm-hmm.
But still, this is this uncertainty which makes you know, a lot of people and ordinary people as well as businessmen worried. Now, if there is a deal, then I don't really see you know, a lot of problems for the rest of the Europe, for the European Union. It could be a problem for UK, and to what extent, let's see, because they are different different evaluations of the impact of the Brexit at UK and European Union. So what is, you know, now really important, like in my case, Gibraltar is a small piece of, I would say, of rock at the end of the southern end of Europe. It is whether, you know, there will be a deal or not, whether, you know, the border to Spain will be still open as it is now. You can cross, even if Gibraltar is similarly to UK is not part of Schengen. So I don't think that Brexit is a major problem for Europe next year. This is the major problem for Europe next year will be certainly pandemic. And in the near term, interestingly, there are most concerns about the economic performance of Central and Eastern Europe, which didn't, as Magda mentioned, suffer much during the first wave of pandemic and lockdown in spring 2020, and then enjoyed a strong GDP rebound in Q3. But now is slowing sharply because of renewed virus outbreaks and the risk of another round of lockdowns, as we see it in Poland. So, you know, I think that that deterioration be temporary, and we will see a sharp improvement in spring on the back of higher temperatures and ultimately on the vaccine. This is the big hope for Europe and US, where vaccines first come, and we hope will positively impact the economy.
And what about the fintech sector then?
You see, fintech, as I mentioned, is not a new, let's say, new issue. Fintech has been developing, you know, for the last few years, and it shows the impact on the financial services industry when in actually all the sectors of the financial services, in payments, you see, the Revolut, TransferWise, Klarna being the unicorns with multi-billion valuations and zillions of customers, and actually pushing the traditional banks towards a new approach to the business, like payments for free, multi-currency cards, FX, low cost, and last but not least, the same in peer-to-peer lending and wealth management. So if we talk about fintech, then let's see fintech like a company specialized very much in particular businesses, and they are very competitive as they focus on the customers' needs and provide low cost, high quality products and services. And this is why they are so competitive as to traditional banks. What the pandemic does on financial services, it certainly speeds up digitization. And fintech is all about digitization and focus on customer. So the traditional banks are somehow forced to restructure, but they cannot really be a fintech, because fintechs are not only high tech, low cost, and high quality, but what they do, they put the digital solutions at work to the extreme, avoiding unnecessary presence in physical world, which is costly. Mm-hmm. And I'm sorry to say, also to employ the human resources to the extent unnecessary.
So in a way, you say that very much in the same line that Magda was saying, that just the fact that it's based on digital, it will speed up, and also it transform the financial sector, also the banks themselves.
Yeah. See, both fintech will, just to summarize, fintech companies and fintech solutions will be visible and more powerful, and the traditional or incumbent banks and financial services providers have to change in order to survive.
Thanks a lot. Irek, I just want you to ask about something completely different, but also very much discussed now. Europe and the US also, a lot of companies who are producers and have operations in Asia, mainly in China, but also in other parts of Asia, think about making shorter the chains of production and distribution. Do you think this is the trend which will really happen, that the companies will withdraw some operations from Asia, or make it just shorter and they will move it to Central Eastern Europe or to, I don't know, Mexico, as far as the American companies are concerned, or mainly to the US or European Union? Unmute yourself.
Yeah. So before answering to your question, I would like to refer to what Sławek has told, that the speed of development of bank services for me, in fact, is a surprise, because I think that this year and the problems, in the economy will enforce banks to change very fast. And as a company, a client of the banks, I was observing two very interesting things. First, this year we have implemented much more financial services, digital services from the banks as a company than throughout all 6 years before. The first. And the second is something which I think is very interesting. It's one of the sentences which I have heard from one of the bank managers we are working with. He told me when we were introducing one of the new services connected to factoring, that they have were discussing about possibility of introduction of digital service connected to factoring for 2 years. And when Corona crisis has arrived, they have done it in 3 weeks. So I think that the conditions enforce also banks, it's not also fintechs, and they really do it. And just 3 weeks and something which we are discussing for 2 years. The first. The second, I think, answering to your question, there is a lot of discussion about this shortening of logistic chains because of disturbances, delays, and whatever. But I'm sorry to say so, but in the long run, anyway, price wins. And as long as the supply from China or from another continent, whatever, will be cheaper, in the long run, anyway, price will win. And especially what was also mentioned before, for example, China is really technologically advancing very fast. In some fields of business, they are even the most advanced. So take into consideration the very high level of technological advancement plus still being price competitive, I think that finally producers, factories and whatever, even if now they do some, transferring some production to closer locations, as long as the price will be better, still it will win and it will not change much. This is my perception.
Mm-hmm.
If I can make a comment on that, one of the issues that is trumping price, and I use the word trumping advisedly, is politics. And what we have seen in Asia is that a number of supply chains are building in a certain amount of dual sourcing so that you can deal with issues where politics or virus impacts can be worked around if you have two sources. And on China specifically, China is becoming less competitive. The working population in China is shrinking, and the Chinese government is trying to push the working population more into value-added manufacturing or services, so that it is getting out of the low-end manufacturing and changing a bit. And so all of those factors combined mean that there is a growth in manufacturing in places like Indonesia and Bangladesh, trying to offer a choice.
So as far as we are concerned, Irek, you say, and also John, maybe not so much hope for Central Eastern Europe. Maybe, well, the businesses will move from China, but not from Asia, actually. But we have a very interesting question from the audience. It's about the role of financial system generally, because we know that 10 years ago, this was the problem. There was really a financial crisis, and the banks and financial institutions were perceived very badly, were accused of, creating the crisis, and even, the way how the crisis was solved was also controversial, because there was a lot of help given to the banks, to the biggest institutions. Now, after 10 years, it seems to be on the other way around, that the financial institutions can help to get out of this crisis. I would be very happy to hear your comments. Mainly, I would start from Magda's perception on that.
So look, I think, we need to accept that since the global financial crisis, running of economies and markets in many ways have been influenced by central banks rather than, the behavior of investors has been, a secondary effect. The effect that you have negative interest rates or very low interest rates, which have been trending downwards, the fact that you've got this incredible amount of money printing that has happened has completely, distorted the behavior of the markets. And so you have, and it's enough to look at emerging markets rather than developed markets to see this complete disconnect between the economy and what is happening to the consumer on the ground and what is happening to businesses and in particular SMEs. versus what is happening to the global financial markets, where the valuations are, skyrocketing and reaching new highs, every single day. And it's an interesting argument as to whether it is a true disconnect, or whether there are some transformational changes that have happened, in particularly developed market economies, which actually justify the valuations that one is seeing. And obviously those valuations, in the case of US, for instance, are largely driven by revaluation of technology and pharmaceutical stocks. But, I always worry about the fact that at the core of, if you strip away all macroeconomic jargon from this equation, at the core of everything is consumer spending. You can reduce the entire discussion around economy to consumer spending. And, from the numbers that one is seeing in terms of unemployment figures coming out of Europe, out of the US, coming in particular in countries like South Africa, that consumer spending cannot be there, because you have, the guy who was flipping burgers at McDonald's and could afford to buy the basics 9 months ago, today is, on the unemployment line and is not spending the money that he could be spending. Add to it the kind of effect of lockdowns, of shops, of, being in London. I've seen, what is happening in even though shops are right now open. I went into Selfridges yesterday, and it's 1/100th of the volume of people that you normally get in those kind of shops that are kind of walking around and looking around and buying nothing. So, my concern is that if, economic growth and success of companies, by virtue of whether they sell products or whether they sell services, it doesn't really matter, is driven by the consumer, then the consumer has been, quite significantly affected by what has happened economically. So it's not really helpful that, look, there is no other response than printing of money. Central banks can do nothing else. They've got a very limited tool set. But my concern is that, we've reached the end of the bit where they can start, cutting interest rates, because we're now at, ridiculous levels. So we've resorted to printing of money, and that usually ends with, hyperinflation coming in at some stage. So, it's very difficult to say, what does the future hold? But, this economic recovery story, I think, is going to take longer than it would if, because, and the major difference between the global financial crisis and today has been that this crisis has affected every single country and every single economy, bar China, in exactly the same way. So, every single economy is on its own. So there's, as I always say in South Africa, we are on our own. No one is coming to save us, and everyone else is out there with a begging bowl trying to figure out where the money is going to come from.
So we are on the same boat. However, we have to always remember that there is this time difference, because China and Asia started first with this problem. So it's 6 month gap if we compare the results. So now maybe, China has this plus result also because they are much later now in the process. We are 6 months earlier, if we can say so, right?
I've got a theory that China was just much better prepared for a pandemic. Well, look, every single government in the world had a pandemic response plan. This is not a new thing. It isn't something that hit from the left field. Every single country, reasonable country, I'm going to exclude some that clearly didn't, but most countries had a pandemic response plan. And in most cases, lockdown was not a strategy that any country was going to deploy. But what happened is, post the Wuhan and China story, social media started screaming lockdown, lockdown, lockdown. And I think a lot of countries globally abandoned whatever pandemic response plans they had and responded to the panic caused by social media largely, and politicians panicked. And so what you are seeing is a panicked response of politicians as opposed to a well thought through response. And what surprises me most in all of this is that, it was one thing to panic in March, but nothing has changed in terms of the response strategy when, 6 months later, the second wave hits. It's exactly the same panicked response. So it's not as if the time has been used wisely to design wiser strategies. It's exactly the same absurdity. And, I can use South Africa as an example where they've just, given it's a country which is completely services dependent and very dependent on tourism. Now is the tourism season where, most money is made in the economy, and there was some hope for some, at least domestic tourism to help the economy recover. They closed down all the beaches as if beach was the main spreader environment for the virus. So that worries me in terms of, the kind of ability for economies to coordinate.
The only difference is now that we are hoping for this vaccine to come. I mean, in the UK, where you are right now in London, they started already, I think, the vaccination process.
They have, and through various investments that we hold, we are exposed to the COVID-19 vaccine. We are an investor in, for instance, the Oxford vaccine project. But the problem with the vaccines is that it's one thing to come up with a chemical formula that works or methodology or vaccine platform that works. It's another to produce, and it's another to distribute. And so it's the manufacturing and the distribution that will become a problem. So I don't see, given the scale of manufacturing that's taking place currently, I really don't see the vaccine as being a solution within the next 18 months, for it to reach the average person and then for it to reach developing markets. That's a long journey to come. And then if you actually consider that all these vaccines are meant to be annual shots, so this is not a once-off thing. You need to scale up manufacturing dramatically, globally, in order to be able to reach 7.5 billion people on the planet every single year. And some of these vaccines require double dosage. So it's a lot of vaccination that needs to take place before the vaccine has a material effect on what is actually happening.
And it's also a logistics complicated because it has to be minus 70 degrees, as far as I know, to transport this vaccine.
Well, it's the new ones, the Pfizer and the Moderna, but the AstraZeneca one not. The AstraZeneca is more accessible, and more normal vaccines will come online in time. But it's time.
Yeah, actually, I find this question very interesting, which has been put on the chat, and you asked whether, in contradiction to a decade ago, when the financial system and the banks were the epicenter of the global financial crisis.
Slawomir, if you can be closer to the mic, because we. Yeah.
And today they are part of the solution rather than part of the problem. But first of all, the answer is simple to the extent that during the financial crisis 10 years ago, the financial services system, especially the banks, the commercial banks, were the cause of the problem, the cause of the crisis. But when you see, the role of the central banks, the role of the central banks were and is pretty the same. As a matter of fact, the central banks saved, the world a decade ago, printing money. And what they do, as Magda mentioned, nowadays is also the central banks are printing money in order to support the economy during the pandemic, especially during the lockdown. But the interesting thing Magda mentioned is actually, the divergence we see in the economy nowadays, while broad equity market indices are at near all-time highs, and at the same time, the economy struggles to recover from one of the most severe downturns ever, right? So, many have concluded that the market is unmoored from economic reality. But viewed another way, today's equity markets may be partly reflecting powerful underlying trends amplified by the pandemic economy. And as Michael Spence, a Nobel Prize winner in economy, nowadays professor at Stanford, says, in fact, the lofty valuations of companies with high intangible assets per employee make perfect sense in today's economy. This is the shift. Even if we see, the market valuations of let's say, tech companies especially, then they are all based first on intangible assets per capita. This is something we observe for the last, let's say, 10 years. It's not only pandemic, but the pandemic speeded up, this what we see, and we see as a divergence when on the other side, especially the U.S. market performing very, very well, and economy in opposite struggling and will struggle in the future.
John, what is your opinion on this question? Is it now the financial sector a part of a solution rather than a part of a problem like it was 10 years ago?
Well, private equity rather enjoys a good financial crisis. The best investments in private equity come in the year or two after a really bad crisis. And in Asia, and I think the rest of the world, there have been no real bargains around from distressed pricing. There have been a number of businesses that have failed or found it extremely difficult to maintain their business strategy with all the impact of COVID. But for most businesses, the pricing hasn't changed at all. So it seems that we're neither part of the problem and maybe don't benefit out of the solution, particularly in this instance. And I'd like to just add a little comment to Magda's point about how important consumer demand is on the strength of an economy. And she, in my opinion, correctly pointed out to China as being a bit different. And what has been the case historically in China is that government expenditure, infrastructure expenditure, was making up over 50% of GDP for many years. And the Chinese government has been trying to shift some of the burden of GDP onto the consumer, and it was succeeding. But statistics coming out at the moment are indicating that China's GDP recovery is quite largely through manufacturing and the industrial sector, and that consumer demand, surprisingly, is quite weak at the moment. And so China is going through a phase where it's saying, how do we really re-encourage consumer demand, because it is missing from the recovery story that we're hoping to present. So it is a financial crisis unlike anything that I've seen in my career, and it does mean that the recovery and the beneficiaries of it are going to be of a different nature. And I think from a very personal perspective, I am quite surprised to see how the manufacturing and distribution of the vaccine is going to be such a drawn-out process. I saw an article recently, I think today or yesterday, saying that poor countries would expect to get the vaccine only in 2022, and that in a number of rich countries, we are still looking at availability of vaccine and the double dosing that is necessary with many as not getting the population to the point where 70% have been vaccinated and you start to then get the benefits of the vaccine. Because of a lack of availability of vaccine, well into the second half of 2021. So the thought that there will be a magic wand and the people will go back to normality by next summer seems to be looking very difficult at the moment, unless a whole bunch of vaccines come up that are using different raw materials and are not going to be subject to supply chain constraints, which seem to be affecting the existing vaccines that are around.
So it's a very important question about also a solidarity at international level, because we know that we are not maybe at the peak of this sentiment, and we are talking about big numbers. Magda said about 7.5 billion people on the planet, but we have 440 million in the European Union, plus the UK 60 million. We have 350 million in the US, but in India we have 1.4 billion people, and in China the same. Irek, if I may follow about this business strategies, I would like to ask you as a leader of a business group and a traditional business, trade. You export different goods, mainly food. Do you expect to do yourself in your group any radical changes as far as innovations are concerned, as far as investments, or maybe some other strategy you are taking into consideration the fact that the crisis is in front of us, so everybody has to think about it?
So of course you have to take it into consideration, there is no doubt, but I would also like to answer for the previous question about the banks as the source of solution, not the problem. So from the trade company who is just doing physical business with export to different countries, including China, Australia, Singapore, whatever, I can say that banks provided us the solutions. Like, for example, it was mentioned before that the supply chain was somehow delayed, disturbed. So it took us just few weeks to introduce reverse factoring, which was discussed previously sometimes for a year. Yeah, we did it in just days. In fact, reverse factoring, which is securing you on the working capital for sure, is the same with very flexible and affordable exchange rate hedging. For such a company, we are just doing it's different currencies. The solution which we have received and introduced on currency hedging, it's extremely efficient, and I have never thought that it would be so quick, so customer friendly, and so affordable. So for sure, I can say just from our point of view that banks have provided us the quick and efficient solutions. Yeah, they have helped us. Probably if we haven't developed the services so fast and digital, we'll be probably at worse situation than we are today. So I must just physically on the example of this company say yes, bank have helped. And on the strategy, I think it's obvious that the diversification is absolutely necessary, so everybody can see that you have to have diversified sources of goods and diversified markets to don't focus too much in one place. But in general, as I would recall that still I see rather the positive development into the future, because now the technology and logistic, even if it's disturbed, it will develop. So I think that after the corona and after the vaccination, the economy will be even better prepared to kind of new start and new opening that we were before, and in the long run it could even speed up the GDP growth and whatever. But I would agree with my predecessors that the case of these poor countries, which will be vaccinated much later, this could make a much bigger stratification also, which means that bigger ones and let's say the richer ones will become even richer, and the poorer ones will become even poorer than they are now. And the stratification between top and the bottom will be bigger than it was before after the corona.
Well, in the European Union, we are still in 27 countries rather rich, and we prepared a very strong instrument of help. As you know, we've just recently concluded, finally, after a lot of problems, the negotiations around the EU 7-year budget and also the extra fund, anti-corona fund. And I would like to hear your opinions also, or maybe suggestions how to really handle this money properly. We are talking about 1,800 billion euros, who will be spent to the European economy in the recent years. The fund will be even quicker. We hope to be able to spend it in the recent 3-4 years. The budget is for the 7th year plus 3, so we are talking about a decade of massive public investment. We can compare it to a New Deal in the US in the 30s. We very much hope for different kind of operations, for, of course, helping the healthcare system, but mainly infrastructure projects, energy, digitalization, and a lot of support to the companies. And also the companies will be beneficiaries of these funds because they will be doing the business through the public spending. We hope that this will keep European Union going. But we also know that we have different levels of cooperation between the governments, the administration, and the companies in different European countries. So in your opinion, what would be needed really? What kind of environment would be needed, and what kind of handling these budgets, these money would be needed in order to have the effect? And the effect we hope to have is the boost of the economy, as innovations we will be able to finally have in Europe, because we feel a little bit in the background, because Asia, mainly China, but also US, are now the frontliners, and Europe is a little bit at the 3rd place. Sławek, what would be your understanding of these funds and your advice?
First of all, as always, with the government spending, the problem is who...
You can close to the mic a little bit closer.
It's always, with the government policies, and especially with the government spending, it is, extremely important who is, in power, and what will be the rules of managing, the money to be spent, and what are the projects, what are, what are the strategies in different, because they might be different in different countries, and this is what worries me, especially for Poland, so that's my answer.
Magda, I know you are not so much involved in the EU situation, but you are also not only a businesswoman in South Africa. You were very active also in the public sphere and in political sphere. You comment. So what would be your advice, if you have to give it to the European governments, what to do with this money?
Well, the first one is, I've observed it and through a slightly different lens, try to minimize corruption around who gets the budgetary allocations and, where the haircut comes from. But, if you look at what Europe is doing right now, and I think it is using the money to effectively spend it on income support. So it's almost like a universal income grant. A lot of people are either furloughed, or people are kind of in this semi-hold, retrenched, not retrenched positions, but basically living off social benefits. A lot of the money isn't really being spent in terms of some massive job creation or infrastructure spend. It is being used to effectively just enable people to live, and the longer people live on kind of universal income grants, the more difficult it is to make them go back to work and productive employment. Now, in terms of money and pools of money that are being made available in different parts of the world, there are different priority projects that they should be spent on, because obviously in a developing economy like South Africa, where you have a lot of unemployment, but it's unemployment of people who are not truly employable, so they don't even have, matric. I mean, we really are talking about, South Africa now has a pass rate for higher level education of 28%. So there you need to focus whatever money you have on large infrastructure projects, because they become large employers of people. In Europe, I think it's going to have to be a combination of, and the wisest course of action would be a combination of some infrastructure projects where you can employ, because, infrastructure is, the only benefit of infrastructure is that it's a mass employer. The technology sector is not a mass employer of people, whereas you need to create jobs. So infrastructure, yes, but the other thing will be the support of small and medium-sized enterprises. And that comes in two forms. Basically, business loans to existing businesses, so that you minimize the unemployment side of the equation. And you enable these businesses to survive, because my biggest fear right now is just looking around London, that many of the businesses that you're seeing, whether it's a small restaurant or whether it's a small corner shop, they're not going to reopen. There's absolutely, they're gone. The sign is up in the windows. So support of existing SMEs, and then putting money into almost venture capital type situations where you start enabling entrepreneurs to start businesses. Because, if I look at any economy, if you enable people to start a business, and through business loans, even small business loans, then one person can become an employer of 5 people. An employer of 5 people means they're supporting 5 families. So I think, for Europe, it will have to become, first of all, it will have to be wean people off the universal income grant. So make people go back to work, and you have to kind of have a structured plan for how you're going to deploy this money in the most kind of job creation opportunities way. Developing markets, it's a very different answer, which is basically infrastructure spend, because there are fewer entrepreneurs, fewer opportunities, fewer consumers. So literally, you just need to enable people to survive.
Well, let's see if this works. If this works in Europe, we have a comment from the floor that to create jobs for others by individuals who will invest in R&D projects, it's quite a long-term solution. It will not happen really quickly. Irek, you are very much into the business, and you are also using the state support from the Polish government side, as all the governments in the European Union were giving this kind of financial help. What would be your advice?
But there is many factors, but I would personally underline one thing which has a crucial impact on this. This is the cost of time in the whole process. I absolutely appreciate what was done by the UK government and the introduction of the in vaccination as soon as possible, as the first ones, because observing some businesses, that there is support from government or different levels, but some forms of business were impacted a lot, like Magda has told, the whole HoReCa business, hotels, restaurant, tourism, and whatever. They were able to survive and just wait for the first 3 months. Now they are hardly surviving the ninth month of the situation, of the real crisis for them. Many of them are just closing the business or bankrupting. So if the solutions, whatever they are, done by the government, if they come quick, the effect will be okay still. But if the solutions are just complicated and too long term, like half a year from now, it will have much bigger impact, just the delay or late efficient solution than technical case of how many percent, what kind will be of the support, is it debt, loan, subsidy, whatever. There will not be many companies just to subsidy or to help if we just wait too long. And from my point of view, in this kind of businesses, especially services, the critical point for each government should be just time to get as soon as possible to this new reality or new normal anyway. All the others are secondary.
So simple and quick. Let's not talk anymore about the budget and fund. Let's just have it. That's a very important message. John, the last word goes to you because our discussion is going to the end. Of course, you can comment on Europe if you want to, but I also would like to ask about the future of Hong Kong, where you work, and how you visualize it in 5 years' time.
I don't have a lot to say on how Europe should spend what sounds like an enormous amount of money, but I have 3 comments. The first is that for Hong Kong, I'm helping the government in a minor way with a plan to put some capital aside to quickly go and support some of the industries, and particularly the ones that have got wiped out, like bars and local services and airlines and the hotel industry, etc., which is suffering for no cause of their own. The second point that I'd like to make about spending money on infrastructure in a developed economy is that if you look at Japan has spent billions on the concept that you can reinflate an economy by spending on infrastructure. But if you have a population that is old and not spending, it doesn't do any good at all. And Japan has been in an economic mess for a long time because they spent a lot on infrastructure and didn't have the other elements that led to a recovery. And the third point I'd make is there are terrible consequences of all of this for our children and grandchildren, who are going to inherit a ton of government debt. In all governments that seem to be deficit spending at the moment, how on earth is that capital ever going to get paid back, which is a real issue. You also asked for a little thought about where Hong Kong may be in 5 years' time. I think Hong Kong will remain an attractive financial center, but the main client for its financial services will be China rather than the whole Asian region. And it will have a slightly diminished role and look much more like a Chinese city than the international one that it is right now. So a slight change in where Hong Kong will be in 5 years.
Thank you very much for this long discussion. I hope you enjoyed it as I did. It's not definitely the last time we will discuss the global economy and the effects of this pandemic on us. So I just want to wish all of us, happy time for holidays, Christmas holiday, Merry Christmas, and also Happy New Year. Let's see what the new year will bring to all of us. Let me thank, first of all, our guests once again, Magda Wierzycka. Thank you, Magda, very much for your time. Chief Executive Officer, Sygnia Group, South Africa, but also operations in the UK. John Levack, thank you very much, John. Vice Chairman, Hong Kong Venture Capital and Private Equity Association. Slawomir Lachowski, thank you, Sławek, founder of Mbank and investor and business person in the financial sector. And Mr. Irek Ozga. Irek, thank you very much for your time as well. Irek is a founder and CEO of Vici Group, the exporter of different goods, mainly food, from Europe to Asia. Thank you all, ladies and gentlemen. Thank you all who were listening to us on Facebook, and a very happy New Year.
Thank you.